Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I want to welcome you all again to a subscriber request Tuesday series that I've been doing here, where I get subscribers who have requested that I cover certain stocks or sectors or industries. And this week I'm going to be covering retail REITs. I've been asked about those quite a bit, but I do want to put a cautionary word out here before I get deep into this video. When I'm doing a subscriber request, I do not want you to automatically think that I'm either recommending this sector or these stocks or whatever it is that the subscribers have requested. What I'm doing is I'm trying to give subscribers some more insights into the investments from a value investor's point of view and what these stocks look like. So just because I'm doing a video doesn't mean I like them. Now, one area that's really been kind of challenged here, we'll say, since COVID has been the retail REIT sector. So let's go ahead and look at this sector, if you will. And I'm going to look at four of the premier retail REITs in the country, if you will. I'm going to be looking at Macerich, Realty Income, Tanger Factory Outlet, and Simon Property Group. Now, I've got their credit ratings listed here in this portfolio review. I do want you to note that Simon and Realty are the two premier companies in this sector. And I'm going to illustrate, as I kind of go through this video, that quality actually does matter. Tanger has a BBB- rating, which is pretty good for a REIT. And then Macerich is not rated at all for whatever reason. So these are all retail REITs, as I said. Now, when I'm looking at price to FFO, it's funds from operations is how you value a REIT. You don't use earnings. You actually use a special metric that they report called FFO or adjusted FFO, or what's also referred to as AFFO. And very similar to what you're doing with earnings, you're looking for companies that have a strong yield, a strong FFO yield. And you can see Macerich apparently has a very strong one, but that can be misleading, as I'll show you. Realty Income has the lowest at 4.93, which would be a first clue that this might be overvalued, even though it's the highest quality REIT probably in here, or certainly one of the highest qualities. And then you've got Tanger, which has a relatively high, almost 9% funds from operations yield, and then Simon at 7.35. So, you know, there appears to be, based on looking at it just purely statistically, some value. Now, these dividend yields are all good here. I want to make that clear because I'm going to be utilizing the new version of FastGraphs when I go through these companies, and we're having a little bit of an issue or a conflict with yields on one or two of these REITs. So these are the numbers that we're going to be looking at. All of these retail REITs are yielding just slightly better than 4%, which is obviously an above average yield. Their market cap ranges from $1.7 billion for Tanger to $2.1 billion for Macerich to $25 billion for Realty Income, and then the biggest of all would be at $41 billion would be Simon. Now, these REITs are all quite different, and so I'm going to go through these with you, and I'm going to kind of go into the website of each one here. I want you to see, the properties. If you're not familiar, Simon is an open air kind of mall that you walk around. They've got, good properties, I guess, all over the country. Did I say Simon? I meant to say Tanger. So these are factory outlet malls. They have a significant number of different products and brands. That's something you can look at by spending some time here in the website. Then Macerich is one that I'm least familiar with, I might add. And this is obviously a picture of their mall where they've got, this looks like a regular normal mall to me with the Cheesecake Factory indoor mall. Again, I'm not real familiar with this one. This is a subscriber request, I want to remind you. And then I do have Simon, and Simon has, properties all over the country, as you can see. These are, just kind of slowly scroll through these from, you got Wisconsin, Minnesota, California, Texas, Massachusetts, Indiana, North Carolina, Illinois, Florida, of course, and so on and so forth. So they've got quite a few malls throughout the country. And then finally, there's Realty Income. And Realty Income is a very interesting one. Again, one of the highest quality. It's dealing with more your names like Walgreens. It does have 6,600 properties under long-term net lease agreements, which is rental income that's considered very, very safe. Their total return has been high, but you got to be careful with that because I'm going to look at that a little closer. They've had 94 consecutive quarterly increases in their dividend, and they also pay dividends monthly, by the way, I might add. So, this is, again, one of the highest quality. So let's look at these from a standpoint of FastGraphs. And I'm going to look at it. I'm going to actually go through. I want to start with Tanger, actually. So I'm going to move on to Tanger. And then I'm going to look at Macerich. Then I'm going to move on to Simon. And then finally, Realty Income. There's a couple of things I want you to notice here. This is the new version of Fast Graphs. And by the way, the yield here is showing 2.08%. We also see that yield on other sites. Simon has had a very good historical record. They had some moderate cyclicality in their funds from operation results, as you can see. But here's what you got to be careful with. You've got to use this tool and analyze the data that you're looking at. It's designed to do that. What I mean by that, if I take my scroll bar and scroll out these negative numbers with COVID, and I do want you to notice that COVID is listed on the graph now as a recession in progress. So we had the recession of '08, the recession of 2001, and now we've got COVID. And, obviously what's happened here is the price of this retail REIT has fallen dramatically, but now it's recovered very strongly here recently. But I do want you to see this from a different perspective. I'm going to go back in time here and look at Simon up through 2018. This gives you a different perspective. We had much stronger growth rates here, which isn't being shown on the graph, but you can see the slope of the line was high. The stock price tracked that very consistently. If I take out some of this anomalous undervaluation here, you'll see that there was a very clear correlation between the stock price and the operating results. But then what happened was, as we kind of came into COVID, we saw a chink in the armor, if you will. 2019, we saw earnings beginning to go down. And then, of course, early they actually closed all these malls. So then what happened was, as we went into 2020, then obviously you had this big collapse in earnings and the stock price really collapsed. And then that's languished. Now we're starting to see a recovery here, and the stock has recovered dramatically. But note that the company did cut the dividend, which is, very troubling for a lot of investors, especially if you're living off the income. The dividend was literally cut in half. And so that's something that, you got to be concerned with. Now, that's a 1 in 100-year event. They didn't cut their dividend through the recession of '08, and they didn't cut their dividend. You'll notice they froze it, but they didn't cut their dividend in the 2001 recession. But the COVID was something that really hit these retailers hard. So you want to take that into consideration when you're looking at names like this. Now, the next one I want to look at is Macerich. Again, this is one that I think has kind of a spotty record. I do want you to note that they cut their dividend from $3.20 to $2.60 to $2.10 to $2.05 during the '08 recession. So that's a predictability factor. The dividend yield is only 4%. Again, I've got a little error. That's one reason why we haven't launched this new version. But, it's offering just slightly better than a 4% yield now. Once they stabilized, their dividend was increasing at a pretty decent rate going forward for the next several years. But then, of course, along came the crisis, along came the coronavirus crisis. And of course, 2020 is a year we all want to forget, obviously. But the reality of it is, now that we're in 2021, the recession is still going on. But, Macerich has started to recover slightly, but there's still a lot of issues. When I'm looking at forecasting here, there is a stabilization expected once we get past 2021, but we're not looking at a great deal of growth. So there are opportunities here. Again, we're starting out with a 4% dividend yield. It's hard to say. When I look at the analyst scorecard here, I do want you to notice that analysts have been right. They've missed estimates about 38% of the time on 1 year forward with a 10% margin of error, and about the same with 2%. But again, you also got to take into consideration that 2020 was brutal relative to what actually happened to these companies. But pretty inconsistent one, a lot of price volatility, during these recessionary environments. As investors, you got to ask yourself, are you willing to do that? You also see the effects of overvaluation and the reversion to the mean. And I'm referring to times now when they were normal, when, growth was running at a normal rate, not, with these very cyclical downturns we see here. So it's something to think about when you're looking at these REITs. The next one I want to take a look at is Simon Property Group. Here's a very consistent REIT. They did cut their dividend during the '08 recession, however, and their earnings, or their FFO, did drop a little bit, but we had this very high correlation. And this is a hard-carrying value investors model, if you will. of how, valuation can really affect future returns and stock prices. We see high valuation reverting to the mean coming into the recession. We see the recession, we see the stock price drop dramatically. We see the dividend being cut, virtually cut in half during the Great Recession, but then rise again for several years until we hit COVID, until 2020 came along. And then once again, we had this huge drop in value. But, these are classic pictures also of extreme pessimism. Look how much the stock has recovered. And the dividend is still considered to be very, very shaky going forward. Estimates are all over the place. I don't like that. We've got kind of a lumpy looking dividend line going forward. I don't know how accurate that'll turn out to be or not. But the point is, prior to COVID, I think it's also important to recognize that there was a lot of controversy relative to whether or not the retail, the brick and mortar retail space was alive or dead, especially the mall. However, there's still some very interesting statistics in that regard that I'll just kind of share with you briefly here. Most importantly, I want to point out the reality of brick and mortar versus online sales. A lot of people, I think, are under the impression that, Amazon dominates and does most of the retail business in the world today. Well, the reality of it is, if you look at the statistics, the numbers are quite different than what you might expect. In 2020, retail e-commerce did jump to $3.9 trillion, or 17% of global retail sales. But that still left, 83% of all retail done in brick and mortar stores. Now, they are expecting by 2024 that to go up to 25%, which, as this headline here says, in other words, in a few years, it's possible that on average, 1 in 4 retail sales will take place online, which would be a significant jump. However, retail in the actual shopping experience is still very alive and real. There's, I've read articles where people talk about how people like the experience, the entertainment. There are certain, some of these retail outlets here do things to bring people into their malls. Tanger has been known to put on all kinds of events to bring, shoppers into their open-air traffic malls. So I don't see retail being dead, but certainly COVID, because these stores actually had to close, put a big damper on these retail outlets. And of the 3 that I've shown you thus far, you can see that that was actually true. But what's really interesting here, if I go back or if I go in and I look at, the granddaddy, the king of all retail REITs, which is Realty Income, symbol O, what we see is, first of all, a very, very consistent performer. The company did quite well. Let me max this out. The company did quite well during the recession of 2001. Their dividend grew during that year. They faltered just a teeny little bit in the Great Recession of 2008, where their FFO initially fell and then kind of leveled out for a couple of years before it started growing again, as you can see. Their dividend, however, stayed consistent. They were able to actually sneak little increases in the dividend each year. And then the dividend growth more recently has been relatively strong. But here's my rub with Realty Income. I love this REIT. Very, very difficult to find it at an attractive valuation. However, if you're patient, I think you can. Now, it really is important. If right now you've got a blended priced FFO of 20.3. So, if I look at it right here, that's a priced FFO of 23. That's getting me about as close as I can get to what its current number is. If I measured that to yesterday's closing price, you can see that I would have made 8.5% annualized rate of return, including dividend income, buying it there at a relatively high valuation like it's at today and holding it with fortunate to be at that valuation. However, if I'd have made that same transaction, just to put this into perspective, during the time when it finally reached fair value, my rate of return drops to 5.6%. Valuation matters, and it matters a lot. Now, had you had the foresight to buy it back in March, during the pandemic, in the throes of the pandemic, when most retail was getting killed, I want you to notice that Realty Income did actually quite well. Now, part of that has to do, again, with what they invest in, the type of properties they have, how well diversified they are, et cetera, et cetera. But nevertheless, this company's operating results did extremely well during the Great Recession. They did extremely well during the recession of 2001, and they did extremely well during this current COVID recession that we're still in. Keep in mind, this recession hasn't been, called over yet, but it's obviously there's been some strong recoveries. So I consider Realty Income a little overvalued. I'd love to buy this again if I could get it down to a more reasonable price to funds from operation of around 15. That would have to fall about 25% for me to be interested in Realty Income, but I'm always interested in it because of its quality. If I go through these real quickly, Tanger has recovered dramatically. It looks a little bit pricey here. I think the future's kind of shaky for this particular company, but it's got a decent yield and it's one that you might want to take a look at. If I go into Simon Property Group, this one has had some really interesting history behind it. They have cut the dividend on occasion. It actually looks quite inexpensive today, maybe the only one that does, but it's not real, super cheap, but given the yield and the potential growth, this could be a double-digit returner. I don't really know what to think about these forecasts as far as what might happen to the dividend going forward. And as far as Macerich is concerned, I just find this one a little too cyclical to me, a little too volatile to me. They seem to have done worse during this Great Recession than any of the others here. I'm not sure what all the reasons are, but that'd be something you'd want to look into and try to determine. But anyway, I think the clear winner here for my money would be Simon. The next winner would be Realty Income if you were patient and waited to be able to get it at a more attractive valuation. This is Chuck Harville taking a look at retail REITs, try to give you some perspective on what has happened to these companies during the COVID pandemic, what their valuations look like. And I do believe the future does have some uncertainty for all of them, but it's not as bad as everybody thinks it is, I think, overall. Anyway, it's been Chuck Harville saying thanks for watching. If you liked the video, give me a like, ring the bell, subscribe to the channel if you don't already, and I look forward to talking again. This has been another Subscriber Request Tuesday, where at the request of my subscribers, I took a look at some of the retail REITs, some of the major retail REITs out there. Thanks for watching.